Well, guys, thank you so much for joining me. Those that are here live, it's really appreciated. And those that are watching the recording, thank you for taking the time out of your day to go through module 2 of the basics of Forex. Today, we're going to be covering what the costs are involved with Forex trading. We're also going to be talking about the different types of analysis that can happen in terms of technical and fundamental. And then I'm going to give you a little bit of homework to go and look at when it comes to candlestick patterns as we go into module 3. This is where we're going to get the nuts and bolts of how to trade Forex. So today's session, or this module, is going to be quite light. We had a heavy session in module 1. And it's going to be a heavy session in module 3. So I don't want to convolute your brain too much. Just want to give you the next stages on. So without further ado, let's crack on. So what does it cost to trade Forex? So relatively speaking, trading Forex and the costs that are associated with that are small, especially if you understand how the fees are structured and follow these guidelines, then you can keep your costs to a minimum. And that's my job for today, is to show you how to keep your costs to a minimum so it doesn't eat into your profits. So the way we price, or the way the costs are calculated in Forex, is by something called the spread. So you will find that brokers will say that we are 0% commission, which is true, but the brokers will make the money on the spread, okay? So what is the spread? So the spread is the difference between the buying price and the selling price. So every time that you buy and sell a currency pair, then you will pay your broker a spread. So in the example here, we have two separate rates, which is the bid price and the ask price. Now, we're sticking with the example that we've been using previously in the previous slides. So we're staying with GBP USD. So if you remember rightly, we have GBP is our base currency and US dollar is our quote currency. We are going to use the bid price, which is if we want to buy and we want to go long and we want to be bullish in terms of the GBP against the USD, and the ask price is the sell price. If we feel like the GBP or the sterling is going to weaken against the dollar, then we would enter with the ask price. So the spread is the difference between the bid price and the ask price. So minus them both. And on this occasion, remember that we're ignoring these last digits at the end because they're the pipettes. So we're only focusing on the fourth decimal place. So in this situation, the two rates are separated by 1 pip. So we clearly see one is at 591 and this one's at 592. So that's it. Simple as possible. Separate by 1 pip. So to take this trade, either way, you will pay 1 pip to your broker. Does that make sense? Perfect. Cool. Lots of Y's, lots of yeses. Brilliant. So how do we keep cost to a minimum when trading the pip? One top tip that I have, just trade the major currency pairs. And why is that? So the major currency pairs are traded in such high volume that your brokers will keep the cost low because they're trying to get as many trades as they can on that. So remember, there's $5 trillion a day that is traded in Forex and that's turned over every day. So if you stick to the major currency pairs, and I have some examples here, Euro US dollar is a major currency pair. GBP USD is a major currency pair. USD JPY is a major currency pair, and USD CHF is a major currency pair. There is normally 7 or maybe 8 that are considered major. So why is that a plus for us also as traders? It means that you have less to think about. You can pull up your charts and look at the 8 major currency pairs and then look for your entries on that. So feel free to reach out to me if you want to find out the other 4, but it's a simple process that you can do by Googling major currency pairs, going onto Forex Factory, which I know a lot of you had questions on previously, but forexfactory.com is a phenomenal site that has great economic calendar tools, which we'll talk about later. And it allows you just to go and look at sessions and the opening times, etc. So good top tip for me in order to reduce your costs is just trade the major currency pairs, and you will get plenty of opportunity whilst doing so. Does that make sense? Good stuff. So continuing talking about the spread, like I said earlier, that most brokers charge 0% commission. However, you do get charged for the spread, like we see in the example, and that's every time that you close out your position. So you'll get charged a pip on that, or 2 pips, depending on what your broker has on the spread. Brokers make profit every time that you take a trade, regardless if you win or lose. So just see brokers as like the casino. The casino always wins, right? Or like a bookies always win. No, they're not as ruthless as those. They feel like that at times. But so your broker, that's how your broker makes money, because they have to make money in order for their business to survive. So in Forex, they're making money off every time that you trade, rather than, commission if you win or lose, okay? So just be mindful of the number of times that you trade, because that can affect the amount that you pay your broker. So, don't overtrade. Every time that you enter and exit a trade, you will be paying the broker a fee and line in their pocket. So the key tip here is just to take the trades that are no-brainer setup, so that you have a good feeling for. We will talk about the trading strategy tomorrow and what you can look for, but just be cautious that every time that you enter a trade that you're going to be paying a cost, which is a pip. So that's going to determine your entries and your exit prices. So, just a quick example, if we know that we want to get in a price at 1.2010, and we have to pay a pip in order to get in there, then we know that we need to have our entry levels either 1.2011 or 2009, depending on how aggressive or how conservative you want to be, because that's the target price when we've done the work on our chart. But we're going to have to pay a pip to get into the trade, so we're going to get filled at one of these 2 prices, because they're either side of that, depending on where the price action is. Does that make sense? Awesome stuff. Nice. I'm either a very good teacher or no one really cares. Let's hope it's the former. Cool. Swiftly moving on. So this is where things start to get a little bit complicated, a little bit complex. But I'm going to do my best to speak about this quite slowly and go through things in a bit more detail. Feel free to stop me if there is any questions, and those of you that are watching the recording, you can always reach out to me at dean@reallifetrading.com with any questions that you have on this. I do think we're going to, after this slide, we're going to get some mind-blowing math going on, which my boy Honglu could probably digest quicker than anyone as a teacher of mathematics in his university that he's in. But for me, I try to keep things simple, and I will show you another tip around that. But let's crack on with what we're trying to discuss. So there is something that you should be aware of called the rollover or the swap. They both mean the same thing, just different terminologies from different brokers. So rollover or swap fees. And what are they? So if you're going to swing trade, so if you want to hold your positions overnight, then you'll have to be aware of the sum that traders can gain or lose during rollover, which is obviously sometimes known as the swap. The swap is the interest rate of one currency in the pair minus the interest rate of the other currency. So it's basically taking the interest of one currency and taking away the interest of the other currency that you're trading, right? So it's taking your base currency and minusing your quote currency. So this may result in a swap benefit or a swap charge, as they're known, depending on the difference between the rate. So what does that mean? It means if you are going long in a position, so you think your base currency is going to go up against your quote currency, but also your quote currency, the interest rate outweighs your base currency, then you will get a swap benefit because you're going long and the interest rate of your base currency is not as much as your quote currency. So you get effectively a benefit. So if you can imagine, if you're an options trader, you are going to get a premium for taking that trade. So that's it. That's you. You get a premium for taking that trade because your base currency, the interest rate is not higher than your quote currency. However, if it's the reverse, then you get the swap charge, which means you have to pay your broker a fee to hold that trade overnight. Simply put, that's how it is. Any questions on that so far? Type in a Y if we're good to continue. Okay, lots of Ys, lots of Ys, lots of Ys. Perfect. Thank you, Ross. Thank you indeed. Perfect. Cool. Well, one important thing to notice when we're talking about rollovers and swap is on a Wednesday, for some reason, and I'll tell you the reasons why. So on a Wednesday, brokers charge a triple rollover because swap rates are charged in a rollover period on a Wednesday night to account for the settlement of the trades that happen on the weekend where there is no swap rates charged. So what does that mean in layman's terms? So basically on the weekend, there is no swap rates, no rollover. So all the transactions that happen on the weekend have to be accounted for, and they normally take 2 to 3 days for the transactions to either be completed or reconciled, which normally falls on a Thursday, hence the reason why you get the triple rate. Now, there is an entire strategy that I know someone that uses that he only trades on a Wednesday, and he tries to plan if he thinks that the swap benefits are going to maximize his profits in terms of holding his price action overnight. I don't personally trade that way. I day trade Forex, so I get in and out in a day. However, you can do that and you can hold overnight. And I have, done some swing trades with Forex, and I will be giving you a strategy that you can use that with and you can swing trade with. I would always avoid holding on a Wednesday personally. So we'll go through that in module 3. But again, you can trade that way. It's just things to be mindful of when trading Forex. Cool. Everyone clear? Just clear my drawings. Let's go. Making good progress, team. Making good progress. So here is where we're going to blow your mind. And this I have labeled useless information. Now, the reason why it's useless is because you don't necessarily need to know how to calculate rollover, because your broker will tell you, inside your platform, he will tell you what it will cost you to hold that trade overnight. Either it's called a swap fee or a rollover fee. So just be mindful, or just be aware of that and look for that. And if you can't see that, if it's not in an obvious place, then just contact your broker and they will give you the rates. But for all of my maths, my numbers nerds out there, or if you just like to know the nuts and bolts of things, then we'll dive into how you calculate that. So there are 3 pieces of information that you will need. The first is the exchange rate of the pair that you are trading. You also need to know the interest rates of your currency pair that you are trading. And you'll need to have the amount that you're trading, so your lot size. Now, we covered lots in module 1, so You should understand what that is. So example, let's just run through the example together. Let's stay with our favorite currency pair in this example of the entire series, which is GBP USD. And I hope you guys know the reason why I chose that currency pair. Not only is it one of my favorites to trade, but I am the leader for RLT UK, and the parent company is RLT US. So it just made sense. and that's it. So cool. We have our currency pair, which we're going to use. The exchange rate, for argument's sake, let's just say it's 1.3850. We've already checked with our bank, and the Bank of England are now giving us a 2% interest rate. And then we've also checked with the Fed, and it's 0.25% interest rate. We are going to take a standard lot, which is 100,000 units of base currency, which in this particular example is going to be our GBP. So we are going to be trading £100,000 worth of base currency. So how do we do this together? So the first step number 1, we minus the two interest rates. So we have 0.02 for 0.02 for the 2% that the Bank of England have kindly given us, minus 0.025 here, pretty poor error, which the Fed have kindly given us. That gives us a total of 0.0175. Let's hope that this math is correct. I'm sure someone will tell me if it's not, but I haven't had time to check, but let's just imagine that it is right. Next step, we multiply the lot size by the difference between the interest rates. So what is that? A lot size we know is here, one standard lot. So it's £100,000. And we're going to times that by our new number, which is 0.175. And that gives us a grand total of 1,750. Perfect. That math definitely weighs up. I'm pretty sure of it. Step number 3, we divide the number of days in 1 year, which is 365, by the current exchange rate, which we know we've got up here, as you remember. So we divide 365 by the current exchange rate of 1.3850, which gives us a grand total of 263.537. Oh, everyone's still with me so far? I know this math is crazy. Type in a 1 if you're still with me. Cool, brilliant, excellent. Lots and lots of 1s. Let's continue. Final part. Step number 4. So then, now we have the figures. We divide the first equation, the 1750, remember it's 1750 here, 1,750, by the second equation, which is 263.57, that number right here, which gives us the total of 6.64. And that would be the cost it would charge us to hold overnight. It would be 6.64%. Okay, so that's what we'd be charging. It's actually not, it's actually £6.64. I don't know why I said percent, forgive me. But that's it. So it would cost us £6.64 to hold that trade overnight. So that's why I'm saying, if you're dealing with small account and you're dealing, you just have to be mindful when you're holding that, because that's £6.64. It might be a large sum for you guys, right? So if you consider when we was talking about how much a pip value was worth, if we made 50 pips in module 1, that's nearly a whole pip using a standard lot, right? So just be mindful of that. You're going to be 2 pips in, 3 pips in before you've even made you're in the green, or you could be 3 pips down before you've entered the trade, because you're getting charged a pip to take a trade, and you're getting charged a pip to enter a trade, and you're also going to be getting charged nearly a pip to hold it overnight, or £6.64, right? So just be mindful of that. Your broker will give you your swap rates and your rollover fees. So no need to know this math, but it's just a good way that I thought we could fill some time and go through things like that. Yeah, exactly that. Good stuff. It's good to know. Probably won't use it. Exactly. I totally agree. And I know there's a lot of headaches going on now, but that's it. But once you just get your head around swap fees, rollover fees, then it just all makes sense. And at least you know how this stuff works. And I think that's important when doing anything. You might not need to fully understand it, but just be aware of the mechanics that go on. I don't know the ins and outs of how to put an engine together, but I do know that my car needs one to drive. So simple as that. Cool. Let's move on. Making some good time. So types of analysis. I can never say this word. Types of analysis in Forex. Okay. Just like stocks, there are two main types. One, technical analysis. Two, fundamental. And we're going to go through them in a little bit more detail. So technical analysis is what I like to do more often than I do fundamental analysis. But what is technical analysis for those that don't know? So the analysis of historical prices or changes to the price, we use that to try and predict future movements. So we do that to try and see what's happened in the past and what did people do in the past to see if we can predict what is happening in the future. And in Forex, the reason why it's really important that we look up historically, support and resistance and things, which we'll just cover, is that price retests more frequently than any other market, in my personal opinion. I think the only other market that really comes close would be futures, I would say. But yeah, it really retests a lot. And what do I mean by retest? So as you can see from the diagram here, we have these two blue lines. Drawing tools. So we have these two blue lines here. These are my support and resistance lines. So what are support and resistance? So resistance or support, however you want to word them, or pivot points as they're sometimes known, they are where the price stops moving. Essentially, it's where the price comes up. So let's just go through this together. So the price comes up, has a little pullback, comes back up again, and then it hits this point and comes down hard, okay? Tries it again, comes back up, gets rejected, falls back down. And it will continue to do that. So you can see that the price level, which is 1.19352, it never gets broken. Now, these wicks come above it, but there's no close above that line. So that's an obvious place of resistance. It means that every time that the price gets to that point, it reverses. So people short or people are selling. So that's something that we need to be aware of as traders. Equally or conversely, when the price falls down into the second blue line, see how it bounces off twice there and comes back up, keeps coming and then falls back down, another little bounce and shoots back up. That's called support level. So every time that the price hits a level of support, we're expecting a bounce in the complete opposite direction. Again, as you can see again, perfectly comes up to the resistance chart, resistance line, pulls back up and just can't break that line. So what does that mean for you guys as traders, or what does it mean? It means that this is a great place where you can get in and get out of trades. So knowing the information that we know now, just by looking at this chart, you could easily think, okay, we're pulling back into a support level here. So let's just get in with an entry there and a stop loss there, and then we'll get out as it gets near this resistance line. So as it gets up here, we might take our profits. And that's what we could have done. If I'm honest, that wouldn't have been a trade that I would have taken, but you get an idea. It's a great way that you can see, how to get into trades and how to get out of trades. Because, for example, if you wanted to go, say you wanted to go long on a trade and you notice that the price is getting near resistance, then there's no way that you're going to be, so for example, this candle here, there is no way that you're going to be setting up an entry here and a stop loss below that, because you're right near resistance. and it's just going to reverse on you and stop you out. So it just gives us a bit of guidance and a bit of understanding of how we're going to plan our trades moving forward. Okay, that makes sense. I know there's a lot of experienced traders here, and support and resistance is the most common technical analysis tool that people use. So I fully understand that, but there are some newbie traders here as well. And if you are, then hopefully that you've learned what support and resistance is. Any questions on that? Awesome. Good job. So fundamental analysis and the importance that it has in the Forex market. So pretty much like stock, you can be a pure chartist and just focus on the charts and what you're looking in front of you and use what we just spoken about, support and resistance and some candlesticks, and you can throw volume and Fibonacci's and RSI as well. So these are all indicators that you can use to trade that, and that's all part of technical analysis. But you can also use fundamental analysis, and there are a lot of long-term spread bettors that will, or speculators, I should say, that use more fundamental analysis than they do technical analysis. So what does that mean for us, or what does that mean in Forex? So point one is fundamental analysis helps traders make decisions based on the economic strength of a country. So, for example, using our GBP USD example again, as we have been doing quite consistently through this course, if we believe that there are strong GDP, gross domestic product, so we believe that the growth rate of the GBP or England or the UK is growing, and we believe that it's not that way for the US, so we believe that the United Kingdom is growing strongly and quicker than it is the USD, then that's a position that a fundamental analysis or a fundamental trader will look to take a long position on, because he believes that country is growing in strength and the other country, the quote country, is declining in strength. So he will use gross domestic product as maybe something that he would look at. You could also look at unemployment rates, and if we think that there is less unemployed, that there are more people in jobs in the UK than there are in the USA, then that would be another reason why someone would go long using fundamental analysis against the USD. So they would go long for GBP against the USD. And conversely, it's the opposite. If you believe that the GBP or the UK or the sterling is going to decline because of high employment rates or GDP is declining, then you would take the complete opposite position. Does that make sense? Perfect. Secondly, things to consider are interest rates. Now, my personal opinion, I think interest rates are one of the most important parts of fundamental analysis. I'm going to be totally truthful and say I don't really use fundamental analysis for my trading. I will show you what I do use in a minute, but interest rates are a big thing because it just helps. What it does for a country is, if your interest rates are going higher, then you're more likely going to get outside investment from other countries in. You're more likely going to get people who are looking to invest and save because they're going to get a good return for their money. If, for example, in our we're using our example of GBP and USD, if the UK are offering 0.1 or 0.10, 0.1, what am I talking about? 0.10% of an interest rate, or USD are offering you like 10%, where are you more likely going to invest in? And what, are you going to go for 0.10%, or are you going to go for 10% return? So its interest rates are very important when fundamental traders are looking to short or long a position. They take that into consideration. So you can see why that's important, and it just shows you how buoyant a company is and things like that. Other things to notice are other non-farm payroll. So Again, how many jobs have been affected and things like that. So just be careful of all of that type of news, especially, which is what I'm going to come on to now, when economic news is released. So things like that, like GDP or interest rates or policies, whenever that news is being broadcasted, either by central banks or the banks of a country, or if the Prime Minister is talking or the President of the United States are talking, or any world leader, that is all going to impact the levels of volatility. So essentially, when I know that there is economic news due to be released, then I do two things. One, I don't trade that currency. If it's going to have a high impact, then I don't trade that for the day. Or I stay flat in and around the an hour or two before and an hour or two after the timing of the release statement, just so I can let the noise or the dust settle on the information that has come out, and then I can begin trading in under normal, and I say normal again in inverted commas, normal circumstances. So, and the reason why I say that, because I don't think trading is ever normal, is it? If we could predict what was going on, then we'll have a lot more money than we did. Now, how do I know about economic news? It's not that I'm not psychic at all. I use a Forex economic calendar, and there's a really good free one on forexfactory.com. So feel free to go and check that out. There's literally at the top when you go onto their website, is something called calendar. Click that calendar, and there will be a host of news that are happening that day and that week. You will find that there's like a traffic light system. So there will be like a little briefcase or a little file, and one of them will be green, one of them will be amber, and one of them will be red. So literally, if it's just some like minor news coming out, then it's green. That's not going to affect you at all. So you're happy trading. Yellow or orange or whatever it is. If it's yellow or orange, then just be wary of that news. There might be some spiking prices. There's some volatility going on that I normally tend to trade still as normal, even with medium type news. I'm just careful around it and try to, to look for, obvious patterns rather than going on my gut, which sometimes I do. But the red stuff, anything that is red, then just avoid that currency pair. And again, it's down to your discretion. You can not trade that for the entire day or the entire session, or you can just be, flat an hour before and an hour after. If you want to know what I personally do, I don't trade that currency pair. Just in case, because a little bit like earnings in stock, people try to predict what's going to happen, and then that just causes so much irregularity that it's just not worth it for me. But that's just me, because I'm trying to, earn my bill paying money by my trading. Everyone okay with that so far? Good, because we are coming nearly to the end now of module 2. Told you it was going to be a quick one. So an example of how you can use both technical and fundamental analysis to improve your trading. So this is just a routine that I actually did when I was swing trading. And like I said, I did swing trade currency pairs for a while before I got into day trading it. And the reason, if anyone wants to know why I did that, is just because I wanted more action, and that's literally it. I like action. I'm an action man, and I want to be more involved on a daily basis. So this was my routine. I literally woke up. So step one, and the first thing that I would do, I would check the economic calendar to see if there is any highly impactful news that is going to affect my trading. And it would also tell me which times that I need to be in and out of trade. So, that'd be the first thing that I do. The next step that I would do is I would pull up my list of currency pairs. And if you remember rightly, I'm only trading the major currency pairs to reduce my costs. So I would get up my major currency pairs, and I would look at it on the daily chart. and I'll look at it on the daily chart and on the weekly chart. So I just want to basically pull a macro time frame up and just get the sentiment of the trend. Is it bullish? Is it bearish? Is it trading sideways? Just so I have an idea of when I start to drill down into a smaller time frame, I understand of the sentiment bias. So that's exactly what I'm doing here. Also, whilst I'm there, I'm going to be drawing my support and resistance lines, as we spoke about earlier. So I'm looking at them places where the price has stopped moving, either as resistance or as support. Then step 3, I check, I switch to a 4-hourly chart, and I plan out my potential trades. So I would pull up a 4-hour chart, and based on support and resistance lines and the candle sentiment, which we will go through in module 3, I would literally write out what I'm looking to happen. So I would be, if the price breaks above this price, then I'm going to look to get in on a retest, or if the price goes below this price, then I'm going to short. And I would just literally go to step 4, and I would just check throughout the day and wait for my triggers to happen. And that's what I did. The reason why I chose the 4-hour chart, literally it's just a number, and that was it. I think sometimes there's too much onus or on like, oh, does this indicator work? Is this time frame best? What's the best moving average to use? I have my opinion and the stuff that works for me, but the same way that the things might work for me might not work for another trader. So I think at times you've just got to pick and then stick with it. And I think that's the biggest problem when I've noticed since I've been coaching and working with traders is everyone wants that microwave recipe that is just going to give them instant results. And that just doesn't happen in trading. You have to earn your stripes. And, if you are a believer in what, our founder, who's also my mentor and my trading coach, if you're a believer in what he says, when he says the market rewards the specialist, then pick your specialism and just master it and become better at it. And that's what I did. I picked a specialism, and I tried to work hard at it. And the better I became at my specialist subject, the better my trading became, and my trading went on to another level. And I can't describe how that changed, how much it changed, and how much that benefited my life, and give me the opportunity that I am in now. And that's what I want to do to you guys. I want to give you that epiphany moment to say, focus on something and become a master at it. And it takes time and it takes effort, but you will definitely you would definitely be proud of the progress that you make if you stick by it. So that's my little emotional pitch to you all, right? That's it. Find something that fits well with you and your personality, stick at it, and become a master of it. Any questions on that? Yeah, of course. So my specialism is I look for trapped traders. So I'm looking for trapped traders. And we will go through this in the plan tomorrow. So I'm looking for people that are trapped. I've literally focused on that using volume and using candle sentiment. And I have become, I like to think, one of the better traders that can do that. There's only a few people in the world that can do it better than me. No, I'm joking. I'm joking. There are many traders that can do it better than me. But it's just something that I focused on. It was something that made sense to me. And once I really understood that and how that actually worked, then my trading took off and I became consistent. And that's what I mean by taking off. I didn't instantly become a millionaire. I just became profitable regularly on a monthly basis, rather than having those moments when, you win some, you lose some, and then you look at your P&L and you break even and you think, why am I putting myself through this? There are easier ways to earn money, and there are easier ways to earn money psychologically. There's very few jobs that you can press a few buttons and earn the type of money you can in trading, but psychologically there's a lot easier ways to earn more money. But that's it. I focused on trap traders and volume, and we're going to be talking about that tomorrow, or in module 3 if you're not joining me live. but just try to think through that. And anything that I can do to help, just let me know. Good question though. Well, I did tell you there's going to be a bit of homework, and this is what it is. So before tomorrow's class, or before module 3, so if you're watching this in the recording, then you need to stop what you're doing now, and I need you to go onto reallifetrading.com and go and download or check out the free ebook created by Jeremy Newsom on candlestick patterns. Phenomenal free tool, so go and read that. There is another tool that you can use, or another resource. If you again go onto reallifetrading.com, so not .co.uk.com, and go onto blogs and type in Tracy Ball or type in hammers and read that article on that as well. And your homework is to understand what hammers are and candle sentiment of hammers before our class tomorrow or before module 3. Okay, so that's your homework. I told you today was going to be shorter than yesterday, and it will definitely be shorter than tomorrow. I want to give your brain some form of rest and get you out within the hour. Does anybody have any questions? Does everyone know where to go and get the Candlestick Patterns book? Right. Yep, the .com. So not .co.uk.com, reallifetrading.com. Perfect. Yep, totally free. It is totally free book. During this whole course, there is no sales pitch whatsoever. That the price that you pay, you just have to listen to my voice, and that's it. Other than that, it's all free. Excellent. Well, look, guys, thank you so much for joining me live. And those of you that are watching on the recording, thank you so much for committing your time. It's a subject that I can keep going on and on and on about, but what I just want to do is just give you the vital bits of information so you can go and earn some money in the stock market, or you can go and trade it profitably. Tomorrow, we're going to be getting into the bit that I love the most. We're going to be getting into looking at the trading strategy that I'm going to give you guys, and we're going to look at some real life examples. Then I'm going to give you a bit of a bonus on what days that are best using this strategy. And also I'm going to give you the days or the times in the year which you need to be mindful of when trading. So probably don't trade Forex days. Yeah, great, pleasure. And I will see you in the next class. Good stuff. Okay, guys. I'll see you soon. Love life, live life, and trade it. Bye.